How's it going today, guys? So today we're going to be talking about a reverse stock split. Now this was a video that was suggested by one of you guys. I certainly appreciate the suggestion. I do have like over 100 ideas for videos that I want to do, but I really appreciate that you guys constantly are giving me new suggestions, because I'm hoping that is a list that just never gets smaller. I'm hoping it just keeps growing, so that way I just never run out of content, and there's just so much to talk about with the stock market that I don't see myself ever running out of videos. But basically, you guys give me some great tips sometimes on videos to cover, and this was an excellent tip, was talking about a reverse stock split. Now it's funny because the person who reached out to me, before this I really had never familiarized myself with a reverse stock split. And about a week after somebody had mentioned this to me, one of the stocks that I invest in through my company that I work for, National Grid, they announced a reverse stock split of an 11-to-12 ratio. And at the end, I'll kind of explain why they're doing the reverse stock split, because it's not the same reason as the example we're going to go through here, which is the more common example. But anyways, let's get into it, a reverse stock split. So basically, in this situation, a reverse stock split is a corporate action in which a company reduces the total number of outstanding shares. And as we've said before, outstanding shares is basically the shares that are held by everybody, both public as well as private and institutional investors. It's the total number of shares out there of that company. They're looking to reduce the number of shares that are out there. Outstanding shares are consolidated into fewer shares. So basically, you have your board of directors. And at a certain point, they're going to say, okay, our stock price is way too low. Usually the issue that they run into is they're risking their stock being delisted. So they don't want to go through that, so they decide to basically consolidate shares, to consolidate a large number of shares into one share. That way the stock price is inflated. So basically what they do is they will oftentimes put it to a shareholder vote. So they'll send around a tabloid or basically a proxy, where basically if you're a shareholder with voting rights, you can vote for or against the reverse split. If it passes, or if they are not putting it to a vote, they basically at that point are taking a large number of shares and consolidating them into one. So my example here, we have 10 different shares, and then it's basically being broken down, or being combined into one share. So this would be a 10-to-1 reverse split. So 10 shares of this stock now become one share of that stock. What's important to notice here, guys, and a lot of people have this misconception with splits in general, whether it's a forward or reverse split, that is that no value is being added or lost. That is because market capitalization does not change during a stock split. What's important to note, guys, is that a reverse split is usually a bad sign for the company. It's not something they do in good times. It's not something they do when the stock is at sky-high levels. They don't go, oh wow, our stock price is so high, let's consolidate shares and 10x our stock price, because then it's less affordable for people who are basically beginner investors just getting started. I mean, you don't want to have your share price be sky high. It's not advantageous in most cases for a company. But at the same time, you don't want to have your share price trading so low that you're risking being delisted. So that's kind of where, in either of those two extremes, you'll see companies doing a forward or reverse stock split. Now, a reverse split, like we said, it's usually a bad sign for that company, and oftentimes it's referred to as a share rollback or just simply consolidation of shares. But like we said here, no value is being added or lost during a reverse split, and that is because market capitalization does not change. So here's two examples here. This is basically, let's say this is a stock that's trading at a very low share price. They're risking being delisted at this point, and they're going to consolidate shares in a 20-to-1 reverse stock split. So their market capitalization is $10 million. They have 20 million outstanding shares, making their price per share 50 cents. That is very low, and they basically want to consolidate 20 shares into one share. So if somebody has 20 shares of this company, they're going to do a reverse split, and now those 20 shares means that person now has one share of stock in that company. So now basically the number of outstanding shares goes from 20 million to 1 million. The market capitalization does not change, so the only factor that can change now is your price per share. So that increases the price per share to $10. But the problem here, guys, is that a reverse split often sparks a sell-off, because like we said, it's a very bad sign for a company in most cases. So why a company does a reverse split, we kind of went over this already. The most common reason is listing requirements. That's because a stock exchange typically specifies a minimum bid price for a stock to remain listed. Now, most stocks, most companies want to be listed on either the New York Stock Exchange or the NASDAQ Exchange. Stocks also trade on the pink sheets as well as the over-the-counter bulletin board, but that's where you run into penny stocks, and those are obviously very those are less prestigious stocks. Those are not the ones that people are usually talking about or generally investing in. There's a very small market. In most cases, good stocks, at least the better stocks, trade on the New York Stock Exchange as well as the NASDAQ Exchange. And they have a requirement, basically, that bid price for a stock to remain listed is at $1. What's interesting is this was actually waived in the 2008 stock market crash because so many stocks were trading so low, they got rid of that requirement for a while. But as far as I know, I haven't looked into it, but I'm sure that at this point there is that minimum in order to stay listed on the exchange of a $1 minimum bid price for a stock to stay listed. So basically, they have a choice. Number one, they can reverse split to inflate the price per share, and then risk basically pushing that stock into a sell-off, because that is a very bearish sign for that stock when they do a reverse split in this scenario. Or they can basically risk being delisted, because if the stock price doesn't recover, then they can be delisted from the major stock exchange and end up trading on the over-the-counter bulletin board or on the pink sheets. So basically, those are their two choices, and this is the most common situation you see with a reverse stock split. What's interesting as well is that reverse splits can actually deter short selling. And obviously short selling, for those of you who guys don't know, those are people who are basically borrowing shares. Excuse me. Those are basically people who are borrowing shares of that stock. And at that point, they are holding those shares and paying interest on them. They're not actually holding them. They basically are borrowing shares that have been sold to somebody else. They're waiting for the stock price to go lower. And then when they cover that position, they basically make whatever the difference is between those prices, minus what they paid in interest to their broker during that time period. That is not good for a stock to have a lot of people who are short selling it. So sometimes you'll have people do a reverse split or have a company do a reverse split to simply deter short selling. The reason that it deters short selling is because, number one, it's lowering the number of outstanding shares, and that makes it harder to borrow shares. And the second is the fact that that limited liquidity associated with a lower amount of outstanding shares may widen the spread, which is the difference between the bid and the ask price. So that's one reason as well that people may consider, or companies may consider, doing a reverse stock split. Okay, so like I said, the company that I invest in, the company I work for as well, announced about a week ago that they were doing a reverse stock split. They sent around a whole letter about it, and they are doing an 11 to 12 split. So basically 12 shares of the stock now become 11. Now my company, National Grid, they are at no risk of being delisted. Basically what happened with them is they sold off a major piece of the business. Okay, so what they're doing is they're paying out a special dividend, and it's going to be paid out to the shareholders. And basically the explanation, because I was actually on the call for that, the explanation they gave for the reason in doing that is that they want to do the reverse split to basically protect their dividends, because they don't want to basically have a lower amount of earnings or revenue coming in now that they sold off a major piece of the business. They don't want that to affect their dividend payout to the point where they couldn't afford to keep dividends where they are. So by consolidating shares from 12 to 11, they're going to be able to continue having a track record of rising dividends that are outpacing the rate of inflation. That was the reason they gave for doing that. It's very logical, and they're also really trying to protect the stock price. You know, the stock as a utility stock doesn't have much volatility, and while many people would understand that this is a good thing for that company because they were able to sell a piece of the business and they got more than what the market expected them to get for that, many investors would look at this as basically see a reverse stock split and think, oh, that's a bad sign. But the reason for them doing this is much different than this scenario. So most commonly it is because of listing requirements, but there are other anomalies out there where companies may do this for other reasons. So don't always assume that it's basically because they're worried about being delisted. Obviously, here's an example right there of a totally different reason to do a reverse stock split. Anyways, guys, that's pretty much all I got for this video. If you did enjoy it, please drop a like on this and then consider subscribing to be notified of any future uploads. And as always, I thank you guys for watching this video.